Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, who is tax partner at GRF CPAs and Advisors here in Bethesda, Maryland. Our mission here on this podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable business value or transferable business value, and then planning for your eventual exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. If you listen to us regularly, you've heard us talk over and over about the importance of an objective estimate of business value for planning your eventual exit. You can't have meaningful planning without accurate data. And so we've always strongly encouraged estimate of value as being foundational to a successful exit plan. And for that purpose, you really don't need what's called a qualified or certified valuation, but really an estimate of value. However, there are certain situations where certified valuation or qualified valuation is advisable, if not required. And it's not unusual for one of our business owner clients to have one of those situations. And so we thought it would be good to talk about it today. And that's our topic: business valuations for gifting, estate settlement, divorce, shareholder disputes. And again, if you're a regular listener, you know that Walter, along with being a CPA and a certified exit planner, he's also a certified valuation specialist. And so whenever we have a situation where a client needs a certified or qualified valuation specialist, Walter is our go-to guy to make that happen, if indeed they don't have someone on their team already. Maybe their CPA is also a certified valuation specialist. But Walter is our guy, and so that's what we want to talk about today. Walter, how should we kick this conversation off? Maybe let's first describe the difference between an estimate of business value, or just an estimate of value, and a qualified or certified valuation. Let's start there.
Yeah, that's a good idea. So, Pat, we always, in our exit planning work, we pretty much step one is preparing an estimate of value for the client's business. And, what that entails is going through the business's books, trying to, all valuation comes down to what is the benefit stream that a buyer is going to receive and how risky is that benefit stream. So in order to determine the benefit stream, we go through the client's books, determine what their EBITDA, earnings before interest, taxes, depreciation, amortization is, make any adjustments to their books that are necessary. Maybe they're renting space to themselves, so the rental is not fair market value. It could be high, it could be low, so we adjust that. Maybe there's some compensation that's too high or too low if it wasn't a related party, so we adjust that, and we come up with a determination of what the benefit stream is. Then we take a look at factors like, do they have systems in place? Is the business too owner-centric? Are there concentrations of customers or suppliers? Do they not have non-competes? Things like that. And we try to figure out how risky the benefit stream is. Then based on those two factors, we come up with a value. And that's how we do an estimate of value. If we were doing the other thing we'll do is, we'll take a look. We have access to certain databases that will tell us what businesses have sold for. So we'll try to get a ballpark based on what other businesses have sold for. We'll try to get a ballpark of what the subject company could be worth. That's a little, that's tricky because you never really know what's involved when you get that, when you access the databases. You don't know all the things that you really need to know about the companies that are in there. But we kind of use it as a sanity check just to give us an idea. Certified valuation.
You might put some discounts on.
Right.
Right. You want to explain what this might be?
Yeah. So then oftentimes there could be discounts involved. So for instance, if we're valuing just a minority interest in a company, that's not going to be worth as much as the full company. So for instance, if Pat and I have a business and Pat owns 70% and I own 30%, and the company has $100,000 of cash, well, my value, you could look at it, you'd say, oh, well, my value is 30,000 because I own 30% of a business that has $100,000 of cash. The problem with that is Pat owns 70%. So he may decide he wants to keep that $100,000 in the company for the next 30 years. So I have no control over that, which automatically makes my 30% subject to a discount, probably anywhere from 15 to 25% discount, because I have no control over what the company does. So yeah, that would certainly come into play. The other discount that comes into play is if it's a closely held company, they're not nearly as liquid as your shares of Amazon or IBM. So there's what's called a marketability discount, which is usually another 10% or so. Usually the combined discounts are somewhere between 20 to 30% in a closely held company like that.
Right. So then what you just described is an estimate of business value with the appropriate discounting, which both you and Corby, who works with me directly as a partner in Ennis Legacy Partners, both of you do that work.
Yep.
However, Corby is not a certified valuation specialist, so he cannot certify or qualify a valuation, which is what you're going to describe now.
Right. So a lot of certified valuations, well, let me kind of give you the categories of valuations other than just doing it for the business owner. So you have probably the second most common would be when an owner wants to gift his ownership in the company to a charity or to family members. And a certified valuation is required for that. And we'll talk about that. There's estate valuations, which is when a business owner dies and the business needs to be valued for estate tax purposes. And that again requires a certified valuation. There are valuations associated with shareholder or owner disputes. So, two owners may be butting heads and they decide, one guy decides he wants out, he wants the other guy to buy him. If their agreements are not specific on how the business is valued at that point, then they would need a business valuation. That one would not have to be certified. However, if it's anticipated that it could end up in court, you're definitely better off with a certified valuation. And we'll talk about that more in detail. And then there's always the potential of a divorce situation where one spouse owns a business. There's a divorce. The business has to be valued for the property settlement. Those are often very contentious and end up in court. So we'll talk about those also. And there are occasions, although not as much, but certain business loans may require a certified valuation. So you can also see valuations done for credit purposes. But that's pretty much the universe of valuations.
Yeah, so let me just follow up with a question there. Two things. Kids, transfer to kids. You mentioned gifting to kids. Would it also, answer this question, would it also be advisable or required if the parents are going to sell to kids to have qualified or certain valuation?
Yeah, so you would not be required to have a certified valuation. You definitely should have a valuation because here's the risk. The IRS at some point could come in and say, well, you've sold it to your kids, but you've sold it to them at a value less than fair market value. So really, you've done a partial sale, partial gift. So you would want to have a valuation of some type done to justify the price that you've set. I mean, a certified valuation would definitely be better. But assuming you really have tried to sell it to them at fair market value, a non-certified valuation, like an estimate of value, would be okay.
Yeah, and so that would hold true too for, when we work with insiders,
Yeah.
sale to insiders. Uh, and insiders not being kids, but key employees, management team, whatever. Um, what's the advice that we usually give in that case in regard to certified or not certified?
I think again, you're okay non-certified. And it's the same risk as the kids, but the idea that here is you could be tempted to undervalue the company so that the person who's receiving the interest doesn't get hit with a bunch of taxable income. But again, if you're really trying to do a fair market value transfer and you've got an estimate of value, that should be fine.
Yeah, let's say that indeed an owner sold to their key employees, two key employees, and the IRS audited the transaction, but and the owner was able to slide across the table a very thorough estimate of value, a process that was documented and clearly thorough, but it wasn't certified. Someone like you who's certified didn't sign off on it.
Mm-hmm.
You ever had a case like that? What do you think? Situation like that.
Well, the worst case scenario is you have nothing. So the fact that you have an estimate of value takes you a long way because the IRS is now coming in probably 2 years after the fact. So they're a little hard pressed to challenge you. If you've done something contemporaneous and it's a legitimate document, with professionals and it's, thoughtful and well done, they're not going to bother you.
Mm-hmm. Yeah. Okay. Now, when someone needs, why do we have clients who would much prefer to opt for an estimate of value versus a qualified valuation? And by the way, would you say this too, that a qualified valuation is an estimate of business value? It's just qualified or certified.
That's exactly right. I mean, the famous saying is business valuation is an art, not a science. People don't like that because, it really is. It has become more of a science. But at the end of the day, you're never guaranteeing that this is what a company is worth. You're giving them your estimate of value. Mm-hmm. And, you see it all the time in divorce cases. You can have two highly qualified valuation people, and they can come up with dramatically different valuations. I mean, you see it in estate and gift too. The IRS hires somebody who comes up with a really high value, and the company valuation person had a lower one. So there's lots of different factors that go into play. So it's a lot of it is subjective for sure, and it is interesting. And this is a little bit of a jaded view, but I think the estimates of value that we prepare as part of exit planning are really, really good. And they're very useful. And I almost look at the certified valuation, which, triples the cost. It's kind of like,
so you just answered my other question right there.
Yeah, well, exactly.
Why do owners, clients, why would they prefer us do an estimate of value?
Right.
Than a qualified or certified value?
Yeah. And so the cost is definitely a big factor. But, I look at it, and again, I said this might be jaded, but the certified valuation, it's kind of like the nuts and bolts are still the same things we do in estimate of value, same work.
Yeah.
But you've added, hey, you've done a quote unquote study of the national economy. Well, that's just a boilerplate that's thrown into the report. You've done a quote unquote industry study. Again, that's usually just boilerplate thrown into the report. You've looked at the 3 methods of valuation. You've looked at asset value, which you basically look at and say it doesn't apply. The market approach, again, you pretty much look at it and say it doesn't apply for small businesses. And then you come down to the income approach, which is the exact same thing we used anyway in our estimate of value. So to me, you've tripled the cost and added a couple hundred pages to your valuation. But at the end of the day, it's really no more, it's certainly no more worth, has no greater value to a business owner than the estimate of value does. It's just that, like a lot of things, it's required that a quote unquote valuation specialist is signed off on it for certain purposes. So it's fun.
Yeah. Okay, good. So now let's mention those purposes again at this point. It's
okay. So before I do that, let me just say give one kind of overriding principle. So, doing tax work, all of our clients, as far as I know, are very above board and their books are kept with integrity. But you always hear the stories of, here's the books I show the IRS and here's my real books. And I did have one time we did a valuation, we did an exit planning seminar, and someone did come up to me after and say, if I show a buyer my tax returns, they don't look so good, but if I show them my books, they look a lot better. And I just, he said, what can I do? And I'm like, well, you can start filing your taxes honestly, and, you won't have the issue. But I guess the point I'm making is, for obvious reasons, you always want to be honest in your record keeping. And that's even, I've had situations in a divorce where the business, I was working with the non-business owner spouse, and the business owner, of course, was claiming that the business is going downhill and it's not worth much. And, they're lucky to still be in business. Well, one of the things we were able to get in discovery was the financial information he had provided to a bank in trying to get a loan. And boy, that was some really rosy information. The business was set to explode. Their margins were going up, revenue was going up. Well, totally different story when it came to what he was telling his spouse. So, it's important. And, I understand certain purposes you want to be maybe a little bit more optimistic than others, but at the end of the day, your numbers need to have integrity no matter what reason you're using. So I'll just throw that out there to begin with. That does avoid a lot of problems if you do find yourself in a situation where you're doing a valuation, especially for divorce, but also shareholder dispute and gift and estate. You don't want to have conflicting financial information floating around. It just totally blows your integrity, and it should.
Mm-hmm. Yeah. So again, those situations, gifting, or maybe even sale to kids, estate settlements, divorce, shareholder disputes. Is that it, or does that cover it in regard to?
That's really it. Yeah, gift, estate, shareholder dispute, divorce,
and transfer. Yeah,
and transfers. Yeah, that's it. So the other thing you're really good at preaching this, and we've talked about it a lot on this podcast, is you want to have shareholder agreements and operating agreements that spell out how the business is valued under different circumstances. So it's going to spell out how it's valued upon the death of a shareholder or member. It's going to spell out how the value for redemption of shares, either upon retirement or pre-retirement. Usually there's a haircut if you don't stay till retirement. So all that really needs to be spelled out. Otherwise, you're basically left with, oh, you want to leave? Gee, well, how are we going to do this? And that's not a good place to be. So you really want to have all that spelled out in advance. And I think we've spent a lot of time trying to drive that home for people. And I think people understand that. And we're seeing that's not really a hard sell anymore.
Yeah, no, they understand it because more than likely they've heard of a shareholder dispute where that's often the source of it.
Yeah.
A buy-sell agreement wasn't specific enough, and it was vague, or wasn't updated the way it needs to be, and so it resulted in shareholder dispute, which then requires, as you just said a few minutes ago, a qualified or certified valuation. Whereas if
Yeah.
they was in the operating agreement or the buy-sell agreement, if they had kept that current, it may not have come to that.
Yeah. Yeah.
Okay. What would you say to listeners in regard to, is it this simple? Look, if you have any question as to whether or not you need a simple estimate of value or a qualified or certified valuation, ask a certified valuation specialist. Is it that simple, or is there any other advice or counsel you would give?
No, I think it's that simple. But you need to listen to the answer carefully because, I'm sure there are some valuation experts out there that would, they obviously, everyone's trying to make money. They want to push a certified valuation. But like I said, if it has anything to do with these areas that we've discussed, they're probably right on in suggesting that. It's one of the things it's also interesting that people will think, well, there are tendencies or there are reasons why, if you're having an evaluation done for gift or estate, you would prefer to have a lower valuation. Because obviously, you want to make, you only can give away or die with so much in the way of assets before you pay estate tax. So if we can reduce the value of a gift or reduce the value of an asset in an estate, that's a good thing. But if you have a valuation done and the person's like, oh, it's like for instance, when I do a valuation, whatever reason I do, I don't apply a 25% marketability discount if I'm doing an estate valuation because I want to reduce the value, and apply only a 10% maybe to another situation. Because, number one, that's, it's kind of dishonest. And number two, that any previous valuations can be discovered as part of discovery. So, right away, you've lost your credibility. So again, it kind of goes back to the same thing as financial record keeping. You just don't want to be in a situation where you have no credibility. And, even, this is a little bit off topic, but just reinforcing that point, even if you're selling your business and someone, the buyer comes in and is doing due diligence, if they find that you've got different sets of projections and, things like that, that's going to shoot your credibility. So I think that, that's important to keep in mind. But at the same time, the big reason, we have right now the estate exclusion per person is like $12.5 million. So very few people are really concerned about estate taxes. However, at the end of 2025, unless something is done, that provision sunsets, and the estate exclusion will go to about half that per person, which is still a big number, but it's not as big. So because of that, if nothing's done, there'll probably be a number of business owners, wealthy families who own real estate, things like that, who will be looking to make gifts to kids and grandkids to try to reduce the value of their estate. And the big benefit in doing that goes back to what Pat mentioned, that's discounts. So if I die owning a piece of real, if I die owning a building that's worth $1 million, that's $1 million in my estate. If instead I gift that to a limited partnership while I'm alive, even though the building is worth $1 million, as we've discussed, the gift is probably only going to cost you $750,000 of exclusion. So right away, there's an advantage to gifting an asset out of your estate rather than dying with it. The IRS a number of times has tried to get Congress to do away with valuation discounts. The most recent, I think, was a couple of years ago. You'll probably see that push again before 2025, knowing that there'll be lots of gift returns files that year. So that's one thing to keep in mind, that there is an inherent advantage to gifting in that there is a discount, normally a discount when you put things into a business entity. So that's something to keep in mind as far as overall planning.
Yeah, you mentioned a 12.5 million exclusion on a federal level, but folks need to know their state exemption as well, because it can be a lot less than the 12.5.
Yeah. Yeah. I mean, it's interesting. I think there's only like 12 states that even have an estate tax, but of course, Maryland and DC are two of them. I think DC's exemption is only 5 million and Maryland's maybe 6 or something.
I think Maryland's is 5 as well.
Yeah. Yeah. It could be.
For 2023.
Yeah. So yeah, you definitely have that as an issue.
Okay. So, hey, here's another question in regard to you being a certified valuation specialist. Can a business owner or client who comes for evaluation to someone who's certified like you, can they expect you to always do a qualified or certified valuation, or there's certain situations where no, you'll say to the client, you know what, you don't need that here. You just need an estimate of value for planning purposes.
Well, the other option that certified valuation professionals have is what's called an agreed upon procedures engagement. So for instance, a business could come to me and I could say, you know what, it's obvious that your valuation is really just going to boil down to what's your benefit stream and what's your multiplier. So why don't we agree? I'm not going to go crazy doing industry research or economic research. I'm not going to bother looking at the asset value. I'm not going to try to look for comparable companies because based on your specifics, there just aren't any. So why don't we just agree that's what I'm going to do? So that's a way to kind of reduce the cost. You still end up with an estimate of value. That's not sufficient for, gift or estate tax, but it would certainly be sufficient for someone. And even in a divorce case, both sides could agree to that just to save money.
Mm-hmm. Okay, excellent. Any closing thoughts? Anything that should be said that we haven't said?
No, I think this has been good. Just that, in closing, I would just say business owners need to be aware when they do certain things, there are requirements, there are valuation requirements, and certainly that would be true with gift and estate. If you're in a shareholder dispute or a divorce, you've got other people telling you you need to get a valuation. Gift even in an estate, really, but in a gift situation, I'm sure there's people out there who do gifts and don't really, think about it. So that's something to be aware of, because if you gift something and don't report it or substantially undervalue it, there is no statute. So the IRS could come back, 10 years later and still go after you. And the way that would happen is, let's say you died 10 years later. As part of the estate, the IRS usually looks at prior gift tax returns, and that would still be open if you didn't have a certified valuation.
Mm-hmm. Okay, very good. Do you have a planning tip, if you will, for folks on this topic here at the end of the year? An exit planning tip?
The planning tip.
A new thing I want to start with these podcasts. At the end of the podcast, give the listeners a planning tip that's either related to this topic or not.
My planning tip, and it's nothing new, we've discussed it before, would be every January, I suggest that a business owner gets an updated estimate of value. Yeah. It helps them figure out if what they've done in the prior year has helped or hurt. Gives them an idea of what the company's worth for lots of different reasons, and helps them set their goals for the new year.
Yeah, it's a good chance they're going to look at their 401k statement in January, or their investment account statements, or the value of their real estate or whatever.
Yeah.
And a lot of times, as we said over and over, this is the largest asset in their portfolio. So Does it make sense to have a good number, an objective number, meaningful number on this asset as you quantify the value of your entire portfolio, as to where you are now, where you want to go, and is there any gap between now and so. Okay, well, very good. Thank you, Walter. And listeners, if you you want help with this, if you need an estimate of value or a valuation, a qualified or certified valuation, or if you have questions about any follow-up questions in regard to qualified or certified valuations, contact Walter. You can contact him at 301-951-9090. You can contact both of us, please do, if you're interested in maximizing the value of your business or planning for your eventual exit. Typical client for us is someone who they want to exit in the next 2 to 10 years. They've got a strong business, they're profitable, they've got people in the team who can help facilitate change, but they don't know what they want to do. They don't know if they want to sell to a third party, sell to insiders, do an ESOP, transfer to kids, a combination of all that. They just don't know, and they need help, and then they need a plan. Well, that's a typical client for us when it comes to exit planning. So 301-951-9090 for Walter, 301-859-0860 for me. You can also access some very helpful virtual planning resources at exitreadiness.com. And if you use the code podcast when setting up your account there, which is free to set up, you'll receive a 10% discount on any products, virtual resources that you purchase there. So we encourage you to go there and check it out. Thank you for listening. And until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.